John, did the southern part of the state get hit with the big storm this weekend?
Yeah, we had maybe 6 inches or so, and some of that freezing rain stuff at the tail end, which was no fun, but
Okay.
it did pretty well. How about you guys?
I'd say over a foot. It was
Wow, yeah.
substantial up here. Yeah. Well,
Yeah.
I'm pretty sore from shoveling today.
Good morning, everyone.
Morning, Abe.
Morning. So, Tim, I think that we have Kim coming on. There she is. All right. Perfect. Well, I will call the meeting to order at 11:01. Is there any need to change the agenda around? Tim or Bill or anyone?
Not from our perspective. No.
Okay. So I would entertain a motion to approve the agenda. I have got Will, a second by Gavin. All in favor, say aye.
Aye.
And are there any announcements from the board or from staff before we get going?
I think I'll just flag, we're trying a new sort of agenda format. You'll see looks a little different. Tried to add times in and kind of highlight the fact that we have a physical and a remote location now. Times are not meant to be anything other than our best guess, so please don't take them to be determinative in any way. Just wanted to try and help folks anticipate where things will be discussed.
Perfect. All right, next item up is the approval of minutes of the January 2025 meeting. Has everybody had a chance to review those? And if no one has an issue, we'll entertain a motion to accept those minutes.
I'll make that motion.
See John. Second, Gavin. All those in favor of approving the minutes of the January 2025 meeting, please say aye.
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 Any opposed? Okay, and that carries. It doesn't look like there's any public in the room with Bill, and I don't believe there's any out in Teams land. So I think with that, we'll turn it over to Empower.
Good morning. Everybody can hear me okay?
Yes.
Good morning. This is Gabe Dulise with Empower. And on the line with me is my colleague, Joseph Fine. Joe Fine will be speaking to the investments of the Munis VMERS program shortly. Tim, forgive me on this. I see Justin, Gavin. I'm seeing new faces perhaps that I'm not familiar with. So Morgan. Real quickly, I don't know who's who. So I guess Morgan's the chair. Did I get that based on how he was running the meeting?
Okay. Correct.
Yes, we do have new board members. Perhaps it makes sense to start this off, Gabe and Joe, with a round of introductions.
Thank you. So, well, Gabe Dulise, I'm the relationship manager. I'm responsible for the overall service delivery and execution of the VMERS program. I work with staff, and at Empower, we also have other plans with the state's DC plan, 418 plans, VSTRS program. So for the VMERS program, municipal plan, I'm the relationship manager working very closely with my investment strategist assigned to this plan, Joe Fine, and you'll be hearing from Joe shortly in a little bit.
Okay, we'll go around the horn with the board. Morgan, I took over as chair when Chris retired. Just kind of call people out, go to Will next.
Hi, I'm Will Liberty. I've stepped into Chris Doobie's seat as the employee rep after his retirement to fulfill his term.
Excellent.
And then John?
Good morning, Gabe. Joe, nice to meet you. I'm John Potter. I'm the town manager in Brattleboro, and I am the employer rep.
Thank you.
And familiar faces on the board will go to Kim next.
Hi, Kim Gleason, and I am the vice chair, and I also represent VMERS on the Vermont Pension Investment Commission.
Well, we know everybody else, so it's wonderful to meet all of you. I'm sure you know everybody else, so we'll just get right into it. So what I was going to do real quickly here, because you probably got an agenda to deal with, is I was going to share my presentation with you. I'm going to provide you with the presentation of the fourth quarter of 2024, what we call our plan summary. So we'll have some comments there. I'll share with you some of those activities. And of course, Joe Fine will then share his investment review report on your funds with some commentary as well. And who's not on the phone, but just some of you do know, Chip Sandville and his team work with the plan. They are our dedicated retirement plan advisors. So they're out there meeting with your participants when they have questions and want to have a meeting or a consultation, an investment review, et cetera, so forth. So that's the team that's supporting all of you. If there are any questions, please feel free to interrupt me at any point in time, or we can wait till the end. But I'm going to just give you some high-level overview of the presentation now as I start sharing. Can everyone see my presentation here?
Yep.
Okay. So as of 12/31/2024, here's on the executive summary, $31.4 million representing 421 accounts. Again, we're now into February. So just as of the last business close, I looked this morning real quickly, the plan assets are up about $1 million to $32.5 million and picked up a couple more participants at 423. One of the items I wanted to point out on this executive summary, you'll see what's called a plan level assets of $21,000. That is what's called your plan expense account. The fees that are generated from this plan are put into this account, and then the state allows us to pay our fees there. And those are residual dollars that are left in the plan expense account to be used by the state or the VMERS board to offset any other plan related expenses.
And I'll just jump in, folks. You'll recall last year we had a fiduciary advisor, RVK, give us an overview of our investment lineup, governance, other things like that. We spoke with the board a few months ago, indicated we were going to do an RFP to bring someone on in a retainer role there. We have had our finalist interviews, and we expect to be moving forward very shortly, and we'll let you know at the next meeting who that ends up being. But we just wanted to let you know that is the source from which we'll be paying those fees, that along with the similar plan expense accounts from all of the other plans, like the 457, the 403Bs. They each have one of those plan level assets accounts. Thanks.
Thank you, Tim. And again, I did not break this down, but we'll get into it more later. Of the 421 participants at the time, 246 were active, contributing, and 175 were individuals that have either retired or separated from service and still have funds in the account. From an executive summary standpoint, we've got an average account balance here. This is a mature plan of about $75,000, so it's right in there with the benchmark. We're going to look at the investment strategy, how individuals are investing their monies, and you have a high level here, and then the actual asset classes, the funds themselves, which being looks like the asset allocation, which is your Goalmaker asset allocation program, has approximately 55.6% of the assets. And then we'll get into these, we'll start peeling down a little bit into the strategy as we go. What I'm going to go into is talk a little bit about cash flow. We're going to look at money coming into the plan, money going out of the plan, and then how it's invested from a high level. So over the course of the year, and you can see quarter over quarter here, 957, just under $1 million was deposited into the plan in terms of contributions, and we'll break down those contributions shortly. 1.9 or 2 million left the plan, so we had a 993 net negative cash flow for the plan, and we'll get into some of those reasons. The one thing I will point out is that, as you can see, the first quarter of 24 is when we did the migration. So what started in as $29 million and is now at 31.4 or 32.5 as of most recent close. But one of the things we'll be talking about later on is you'll see the change in value line on the bottom. Although it was a very good year in the markets, and Joe will speak to that, the fourth quarter was a rough one. And we'll get into that as well. When we look at contributions for the plan, there are two types of sources here. There's the employer contribution and participant before tax contributions. And as you can see there, that of those 957, approximately half was employer and half was participant before tax. And you can see a month-over-month run rate here of contributions for the plan, which looks like it runs anywhere. Total contributions are probably in the, what does it look like, 60,000 range there, 70, 80, a couple additional contributions during the course of the year. And then these are the individual transactions over month of participants and the contribution amounts. When we look at money leaving the plan, like I said, we had $2 million leaving the plan, and that was broken down as follows. Separation for service. So $1.9 million was the bulk of that of 174. And those consist of individuals that are taking either installment payments or they've just taken a total withdrawal. You know, they've retired, they've left, they've taken their assets with them. And unfortunately, we had a death situation there where one individual death case, which represented almost $50,000. So there's the breakdown, if you will, of that transactions. And we also show it down by month here in terms of normal distributions from the plan. But the majority of those are individuals that have retired and are taking installment type payouts. When we look at participant balances, again, average of 74,000, the median. This is just based on your participants in the plan and the percentage that, the distribution of those account balances across the board. We're going to look at the investment strategy now a little bit. We're going to poke down at this, and it consists of a couple of different categories. There's what's called My Total Retirement, which is the fee service, which is for managed accounts. These are professionally managed accounts. And then there's online advice, which is free, and looks like one individual was using that. Your target date strategy is your target date funds in the plan, and we'll talk to those through your interview. Your asset allocation model there is Goalmaker. There are about 37 participants there in that plan, and then the rest, the 30% or 123 participants, do what's called the do-it-yourself strategy, and it's very common in the government space for individuals to do their own private asset allocation. In other words, they join a plan, they're going to determine what fund or funds and how they want to invest in those plans. And to the right of that is the corresponding assets and as a percentage of assets for all of the plans. So as you can see here, there are 14 individuals representing $87,000 that are having their accounts professionally managed and paying for it. One individual is doing the free online advice. The target date strategy, here you see here 244 of those, representing almost $14.8 million. Goalmaker, the asset allocation of another 1.3, and then the bulk of the rest of the 123, almost half of your participants, representing 15 million, are utilizing their do-it-yourself asset investment strategy utilization. And then we give you a breakdown of those that are active versus those that have separated from service or have retired. As you can see, a lot of individuals, even when they do retire, leave the money in the plan, right? So there are 107 that are still utilizing the target date strategy and the corresponding assets. So if you were to add these up, you can see that there's a good amount of your participants that have left in a plan that are still in the plan. Advisory services. This is the managed account solution, the pay service. As you can see, for when this was launched at the beginning of the year, it started from 3 people and we're down to 14. It starts to plateau out, which is what we normally see from individuals that want to have their accounts professionally managed by themselves, for them, I should say. So we've got 14 individuals there. When we look at Goalmaker, which is a free asset allocation solution, this has been in the plan since Prudential, back in the day when Prudential was your provider. We started with 35 individuals, and it looks like it's pretty much plateaued out at about 37 individuals over the course of the year for Goalmaker asset allocation. And again, we also break that down by strategies and the number of participants that are by age group, where they're contributing those portfolios. And then we even show you the Goalmaker assets in the portfolio. So of the 31 million, there's 1.3 million in Goalmaker. And Goalmaker utilizes the funds within your plan, which is why we show Goalmaker versus non-Goalmaker here as well. Sorry, my screen jumped. I apologize. And again, we're going to get into these different investments. As you can see, the majority are your Fidelity Freedom funds, which are very, very good funds. And then the Goalmaker program and the assets within Goalmaker and non-Goalmaker giving you the total. So 30.1 million or is not in Goalmaker. These are individuals that utilize target date funds or other strategies or do it themselves. Now, when we look at all of your funds in the plan, we start with your asset allocation funds. Again, the advisor freedom funds, the balances, the number of participants here utilizing those strategies, and as a percentage of your total asset. So we go through all of your funds here. And again, less than 5% is in your stable value solution at $1.4 million. So those are all of your funds, and then activities for transferring and rebalancing, and then some additional insights that kind of just shows you the lifetime score, which is a replacement ratio that participants using it. This isn't a very large plan, and you've got 400 participants, but based on just the demographics of that, you've got a very good diversification of the portfolio. You don't see a lot of highly concentrated in your stable value, for example, less than 5%. So this is a very active fund. It's a well-diversified fund. And as Joe will get into the investments, you get a pretty impressive fund lineup as well. And then we give you a breakdown by age groups, et cetera, so forth, assets, just additional statistics. But at the end of the day, you know, of your portfolio, when you look at the plan, you know, with an average account balance of just about 75,000, you've got good participation. You get a healthy mix of active and retirees. So of the 423 participants and $32.5 million, this plan is working exactly as it's designed to do. So can I pause? I'm going to pause here to see if there are any questions that I can answer for you with respect to just some of these prepared remarks and just some observations. Otherwise, I will then transition to Joe. So I'm going to stop sharing for a moment. Happy to reshare if I need to, though. Thoughts, comments, questions? Y'all getting rich? Is that y'all happy? Okay. I thank you for your time and attention. It's looking pretty good. So with that, Joe, I already planted the seed. It was a fourth quarter, but I'll let you take it from there, pal.
Thank you, Gabe. Everyone can, good morning, everyone. Nice to meet all of the new members, and thank you for having us. Looking forward to working with you, at least until the fiduciary advisor comes on board. So beginning on page 4 of the investment review document, if you're following along, really just want to skip to the bottom set of bullets and speak to the fact that it's interest rates and inflation that's really driving what's going on in markets most recently, including obviously the fourth quarter and the year to date period. So if we, interesting, that's better. So if we turn ahead to page 6, want to just speak to a couple of things that occurred, as Gabe mentioned, during the fourth quarter. It was not a great fourth quarter unless you were in large cap growth stocks as represented by the Russell 1000 growth or Russell mid-cap growth stocks. Other than that, it was, decent, but not great, and certainly not great in international markets. Now, some of what I'm going to be talking about is not in the book. We do like to bring things up to date through a current date. So interestingly, if we look on a year-to-date basis, foreign developed markets are actually performing better than U.S. markets. So somewhat of a reversal of what we're seeing here. If we look at the year-to-date or one-year trailing column, see pretty robust returns across the board, except for growth leading value by a pretty wide margin, which has been the theme for, a number of years now. And you can get a sense of that looking to the far right at the annual returns, except for 2022, which was a really down year. So a couple of things impacting your funds directly that we're going to speak to a little bit more. This concentration in large growth and mid growth, as well as international returns being behind, are impacting the target date series to an extent, depending on the vintage we look at. Turning to page 7, you see a lot of volatility here in the fixed income returns. Fourth quarter was negative. 1 year trailing was positive for the most part, except for longer duration strategies. So not that your government income offering is long duration, but relative to its peer group, it is. So that's impacting the results we're going to see there. And as well as interest rate volatility impacting your one of your international offerings, small to mid-cap growth international offering. So that's why we go through the market results to help bring context to what's going on with a number of funds, a number of your funds. And we are going to be speaking to more than we typically do because of this highly volatile and concentrated environment that we've been seeing. It's common when we have these kinds of environments for institutionally oriented strategies to struggle with these kinds of environments. So the last slide I want to pause on before we get to the funds themselves is this unprecedented level of market concentration that we've been seeing in large and mid-cap growth. So the picture speaks for itself. You see the percentage of assets dominated by the top 10 companies in each of these indexes. So when you see that kind of concentration, again, more diversified strategies are not going to do as well. Any questions here before we move ahead? Okay, so I'll take silence.
Joe, real quickly.
Being golden.
Joe, I know the concentration that you're speaking to is primarily the Magnificent Seven. Could you just remind us who those 7 are? You probably speak to it.
Sure. I could do that. I'll jump ahead to page 54. So yeah, I don't remember them all off the top of my head. NVIDIA, Microsoft, Alphabet, Meta. Those are
Apple, right?
4 of them. Apple, Tesla. I can't remember the 7th one off the top of my head. But they're probably all in the S&P as well. The one I'm missing, I guess, is Microsoft.
Yep.
Perhaps Amazon. So those are those stocks. And don't ask me about the mid growth names. I have no idea.
No, I won't do that to you.
If I could ask everyone to peruse pages 29 to 33. I will also point out that there is, commentary on each of the funds we're going to stop and pause on, summarized on page 35. You don't have to follow that along. I will speak to those as we go through the returns here. So as I talked about, I'll keep it larger. There's a bunch of numbers hard to see. Just so you get familiar for those members that are new with the formatting here. It's unfortunately a bunch of numbers, and as you see me blowing up the page, if it's the formatting leaves a little bit to be desired. But when we look at the 1, 3, 5, and 10-year returns here, we've got a 1-year return number and a peer rank. So 1 through 50 is a good peer rank. 51 through 100 is a bad peer rank. Right? So top half, bottom half is basically how it works. And also include index benchmark as well as the peer group median. So those are the 3 rows and the important columns. So the comments we make are primarily based on the 3 and 5-year peer ranks. So thought I would point that out as well. So you could see the struggles of the government income fund here, particularly 3 and 5, but they are not far behind the peer group median. So you always see tight ranges of returns when it comes to fixed income reporting. So I already spoke to the fact that the fund has a little bit longer duration. So at the far end of duration for this peer group. So we talked about interest rate volatility. That's the reason for the underperformance. The risk characteristics, we could turn to another page to see all of that, but that would be on page, forgive me, page 36, but we'll leave that for you to review on your own as you desire. So the other thing that's important here is we bypass the funds that are doing what they're supposed to do, right, from a performance perspective. So the funds that are passing performance, we're going to bypass, but the overwhelming majority of your funds, are performing really well, as Gabe pointed out, a very strong lineup. And even these funds that we're stopping to pause on, there's really not a lot fundamentally wrong, in our opinion. So when it comes to the target date series, again, we're going to see some noise in the shorter dated vintages. Now, again, this is not in the book, but I did want to point out on a year-to-date basis, the target date offerings are performing very well. Most of the vintages are at the top of the peer group, meaning the top 1% or top 2%. A couple of the shorter dated ones are more in line with their peer groups. So there's not a lot of concern here. In fact, we would have only commented on the shortest dated vintages here if we were doing this today. In other words, a number of the longer dated vintages would be passing that 3 or 5-year performance criteria. So again, Gabe pointed out a really good target date series. So not a lot of concern with the noise that we're seeing within the numbers. So I am going to jump ahead to page 31 and stop and pause on Domini Impact Equity towards the middle to bottom of the page, right below the large blend category. So what you see here is, for the year, a fund that returned more than 22% ranks in the bottom 20% of the large growth peer group. We talked about the diversification, the lack of diversification within the benchmark, and to an extent, this peer group. So this is not a pure growth strategy. That's why it's behind. It serves as your domestic equity, socially responsible investment option. So over time, we will see noise like this again in this kind of environment, whereas a fund like Fidelity Blue Chip Growth which is a pure growth offering, would be near the top of its peer group. So not a lot of concern here. And moving ahead to page 32, we see a little bit of noise in the Janus Henderson Triton offering in the small growth space. Manager portfolio management team, again, these comments are on page 35, wrote to the fact that there's not a, it was really only several names that drove even this space, the mid to small cap growth space. So not an awful return for the 1 year, and the 3 year is just behind the peer group median. So, if the number was slightly better, we wouldn't be even stopping and pausing on it. The good news is on a year-to-date basis, fund is up 3.6%, ranking in the top third of its peer group on a year-to-date basis. And that 3-year number is still slightly behind. So no concerns here. The Columbia Acorn International at the bottom of this page. Again, when I was speaking to interest rates, management pointed to interest rate issues with the fund underperforming. You could see did not have a good calendar year at all, and that's dragging all the returns down, the 3, the 5, and the 10. Now, interestingly, when we look year to date, this fund is up 6.4%, the top 20% of its peer group, and the would actually pass the 3-year performance metric. So that's the kind of volatility we could see with these rankings because of the volatility we've seen in the market. And then last but not least, we could turn to Impacts Global on page 33. As you could see, really on a relative basis and absolute basis, poor fourth quarter and calendar year. They clearly spoke to in their comments the market environment and the lack of diversification, as opposed to the third quarter where we saw better performance from Impacts Global. So again, dragging down all of the trailing returns. This fund also is done, it's somewhat better on a year-to-date basis. It's, up 4.6%. It's below the peer median, but not as far behind as we saw for the calendar year. So a lot of positivity in the midst of all this volatility and the strong results that we're seeing on a year-to-date basis. Domestic stocks as measured by the S&P are trading near a record this morning. Seen markets flat to slightly positive this morning. And the last two things I did want to point out were 2 of your index offerings are lowering their fees. The Vanguard Total Bond Market Index Fund, that's part of the plan. Expense ratio is dropping from 3.5 basis points to 2.5 basis points. And this isn't formalized within the book anywhere because it's very recent news within the past week or two. And the Vanguard Total International Stock Index fees down from 9 basis points to 6. So pretty significant reduction there. So as Gabe did, I'll just stop sharing for a second so I could see everyone. And if I need to share again, I will. I just want to see if there are any questions or comments.
Joe, I was going to add just one comment on that Impacts Fund. There's a question from Kimberly on that Impacts Fund that you talked about. There's only $18,000 in that fund when you look at 32 million. So it's important to put it in context when you see some of these returns on the fund. to check the corresponding assets and participants. So that's all. I just wanted to mention that. Kim, I'm sorry. Please go ahead.
That's okay. I was just checking in to just sort of probably say out loud, we meet our fiduciary responsibility in offering a variety of investment options, diversified. And so we are in these set of slides focusing on the ranking of some of those that are trailing, but there's a broad diversification. So there's nothing compelling us to make changes in the investment offerings by virtue of the fact that some of these are trailing in their rankings. And I'm going to make that a question just to sort of confirm my understanding of our responsibilities in the array of offerings that we are making to our participants.
Who's the question to, Kim?
I
Sorry,
guess
I'll
I'm
let Tim take that
gonna
one. I'll let Tim take
offer
that
that
one.
to the universe
Yeah.
and let you all reflect back on that question.
Thank you. Tim?
Yeah, thanks. So what I like to do with these reviews is to really kind of, this is the initial beacon in my mind. When Joe and Gabe present the plan overview and the investment review, it's kind of giving us an initial sign about whether or not things are going well, things are something that we want to watch. And so, I don't view a something that makes the warning sign list. I don't even want to say a warning sign, but something that raises a flag here. I don't see that as a sign to act immediately. I see that as a sign to keep watch and then to work with a fiduciary advisor, like we did this past spring, and like we plan to continue to do once we finalize this RFP process. And it's really that fiduciary advisor that is going to ensure we meet our fiduciary oversight, because they're the ones that are going to help us take what Gabe and Joe are presenting to us and dig a little bit deeper. So your point is a good one from a 60,000 foot level, that we have 19 funds in this plan. We have a diversified option. We still have an obligation to monitor those and make sure that those offerings are all good. And we do that through this multiple step process. But I do think it's important not to see something make the commentary list that Joe provides right now and then say, okay, we got to move out of that fund. I think I see Joe nodding his head. That would be a misuse of the sign, because it's, anyone can have a bad quarter or a year. And as we always talk about being long-term investors, we want to make sure these funds are good for the long haul. And that's sort of the reason why we do this exercise. I hope that provides an answer.
Thank you. That was really sort of the affirmation that I wanted to sort of put the conversation on the table to make clear with our diverse offerings, the fact that a fairly substantial list was, falling potentially behind the benchmark or in the rank order in the lower 50. I don't know to what extent we should, as a body, consider sort of, again, back to the maybe 30,000 foot level, policy on our review of the plan offerings, whether or not that's advisable. And maybe that's something we can ask our fiduciary advisor when under contract to consider process in addition to practice. Because
that is their process,
I
Kim.
think
That's exactly their process. What they're going to do, and Tim, if you don't mind me jumping in here real quickly, it's very common for a plan to have an advisor do everything Tim was talking about. As part of that process, there'll be what's called an investment policy statement creation. And that advisor will develop a policy in conjunction with you. And then that policy statement will have guidelines that says, we'll keep a fund on watch for 4 consecutive quarters. After 5, it gets replaced for consideration. So those are all the things that you're talking about, is what your advisor will provide. And that's something that Tim and staff are putting together. Yeah. Very common.
The
very
benefit
common.
of my multiple hats.
There you go.
We have a watch policy on
Exactly.
VPIC.
Yeah.
So I would presume that makes sense in our role here too. Thank you.
And Joe was focusing on the 3 and 5, which is what most advisors will focus on for a retirement plan, right? It's important to have the 1, 3, 5. We saw the red in 22. These things happen. But if you focus on, again, a long-term investment, that's why the 3 and 5 is very, very important. But that's up to you all when you work with your consultant to decide maybe you want 10 or maybe you want 1, 3, 5. It's all up to you how you create that policy.
And I think for me, the thing that was helpful to see was the ranking relative to benchmark, because
Yes.
chasing returns never makes sense.
Bless your
But
heart.
considering longer term performance of the funds relative to their benchmark, I think is
Yeah.
a appropriate framing. So thank you.
Sure.
But even that, I'll just caution, even that can be a little bit tricky when, I recall some commentary from Joe about where a fund has benchmarks, but maybe the fund is, Joe, I think you've used in the past the term a tweener, where it kind of will exhibit different characterizations. So maybe the benchmark is useful, but not perfect.
Right, Domini is a
So,
great example of that. And
right.
when this discussion is over, I see John's hand is raised. I'm going to share again because I think there's a set of slides. We'll go through at least one fund that's important to go through that I potentially shortchanged. John?
Yeah, thanks, Joe. And Kimberly's question and Tim's answer were really helpful for me to understand kind of like your role, uh, Joe and Gabe. I'm curious about the like looking ahead. Is that also the analyst's role to be like Joe mentioned a couple times, like about volatility and that sort of thing? Is that part of Empower Services to say, hey, we're seeing things are going to be really volatile over the next year and a half, and we think we should be looking at these other funds, these different products? Is that something that is just the role of the analyst, Tim, or is that also something that Empower helps us with?
I think Empower helps us with what that not in the same way. I think everyone has a role here. Empower helps us see what's happening with our funds and gives us a sense of their view of the market. You can see some of that in the market commentary here. But for the sort of the fiduciary relationship that we're going to have, that's going to be with our fiduciary advisor, and they're going to be the ones that we're going to drill down a little bit more on those questions with. For example, also, John, maybe this board thinks that there should be a different number in our lineup, right? Maybe we want fewer offerings. I believe this is 19 in this
Yeah, 20.
in this plan. Others have fewer. Those kind of more foundational questions about what to offer, when to make a switch are going to. I would urge the board to take a strong consideration of what our fiduciary advisor is telling us on those. But again, I think that Empower's role is really that first line of awareness. And that's why when I, just to share my screen for a second, when I get Joe's report, this page 35, is the first one I go to. This is the list of, the one where there are concerns. And then I work back from this list and see, of what Joe was, if one of those funds pops on the list, then I kind of go back here and try and understand, has it been a long time? Is it a short time? And then stepping back further, go back and look what our fiduciary advisor from last year told us about the fund, whether or not it has a stable or a neutral or positive outlook. So I always think of Empower as that first line of awareness that we have on all these funds, and they do a really good job with that. But it is really, it's this board's role in conjunction with our fiduciary advisor to turn what we're seeing here into some kind of action, whether that be change, stay, what have you.
Great, thank you. That's really helpful.
Well said.
Tim, did you have an additional comment?
I did. I was just reminded as you mentioned, Domini, um, recognizing that on VPIC, the title of our what was formerly ESG committee transitioned to stewardship committee, and sort of highlighting the social awareness that is part of that investment strategy on Domini. And in the context of today's environment, I'm presuming we remain satisfying our fiduciary obligations without any undue risk in continuing to offer an account that is an option for people to invest.
I think that is definitely a question for the fiduciary advisor when he or she comes
Yeah.
on board. That whole the as I'm sure you're aware, Kim, and potentially others, there are states that embrace stewardship, and there are states that do not. So definitely would shy away from that kind of conversation, but it is important to be aware of.
Yeah.
I
And I think
did
again
want to.
here, it's not required that anyone should choose that as an investment, but I am
Exactly.
almost thinking in the population of our state and our investors, I would be disappointed to see us shy away from an offering unless required. So anyway, that is more personal.
There's no mandatory
Particularly-
investment in any of these. There's no mandatory investment in these, right? Participants get to pick
Right.
and choose. And I always share with Tim best practices, right? A lot of organizations still utilize socially, conscious fund types of investments. They make them available. And in their minds, they're meeting their fiduciary obligations by making them available because they're not telling anyone what to pick and choose. They've been struggling financially a little bit, and a lot of organizations are rethinking that. Should we make it? Should we change it? And that's where your advisor will come in and really give you some guidance there. But I will share in terms of what I've seen from organizations that utilize these funds, they're keeping them in the plan because they're completely voluntary.
Yeah. And I
That's
would
it.
imagine that would be different if we weren't offering another choice under large growth. I mean, I think those are the sorts of things that sort of resonate for me as I look at our array of offerings. And I would encourage us as we embark on that conversation with our fiduciary advisors.
And this is something you could
think in that way.
Go ahead, Joe, because I had one last comment. Go ahead.
Yeah, and as Tim pointed out, that's definitely a fund, I have classified as a tweener, and, without turning back to the page, it's a Morningstar categorizes it as a large growth fund, but a fund prospectus benchmark is the S&P 500. But as, we've been talking about, even the S&P 500 has been, a bit off kilter, if you will, because that benchmark is being driven by the magnificent, quote unquote, magnificent seven as well.
Yeah.
Okay.
Final. Can I make one more final consideration? Again, when you talk to your advisor, again, best practices. There's some school of thought that is you want to have a fund offering in every specific asset class. Some say we want giving people choice, 2 funds in every asset class, 2 or 3, which is fine. What I would caution you is if you say, I got 5 large cap growth funds or 7 value funds, that creates analysis by paralysis, they call it, right? But these are all conversations that you should have with your advisor. What we found to be, what I think is what I see the sweet spot is 2 or 3 funds per asset class gives people choice. That seems to be the sweet spot. But again, I'll let your advisor and work with all of you in terms of what you feel is most appropriate. And then you build a program around that. It's that simple. Hope that helps.
So I did want to go through a couple of these fund analysis detail pages, right? Because I may have made reference to 1 or 2, and I skimmed over it quickly. But with respect to impacts global environmental markets, first thing, is its portfolio composition: 68% US, 31% non-US, 1% or so cash. I'm rounding. So right? So with that heavier percentage in US stocks, and I talked, and it's on page 35, the portfolio management team speaks to, the lack of diversification in the market. So they're not investing in the Magnificent Seven, and you could see that here in the top 10 holdings. The only one that's there is Microsoft, but it wouldn't be in the percentage that even you would see in the S&P 500, right?
Right.
So the other value of this page, there are risk statistics at the bottom, right? Volatility measures, and these are defined in the glossary of the report. Things like Sharpe ratio, how a fund does in up markets, down markets. But again, all of this can be skewed by what's going on in the market environment itself. What I think is more important is the 3-year rolling performance relative to, and as Gabe and Tim were speaking to, not even necessarily the benchmark, but the peer group. And it's hard to discern and see, but you could go through this on your own. And then maybe even more importantly, because it's easier to see, the calendar year returns. So this fund, relative to either benchmark or peer group, has struggled for 3 consecutive calendar years. But it doesn't mean it's a bad fund anymore, right? The portfolio manager didn't all of a sudden forget how to invest. Again, it's a function of the environment, potentially. So these are the kinds of things your fiduciary advisor will dig into more. Because when you look at the prior calendar year returns, they're pretty strong, save 2018. And similarly, we could look at Columbia Acorn International, just back one page 63, different profile, right? Had a strong 2023, week 24, week 22. The rest of the calendar years are pretty strong, save perhaps 2020. So these are the kinds of additional things that, I'm sure your fiduciary advisor will get into, and that we consider when we make our comments to you. So given the broader discussion, thought it was important to go through that page as well, at least partially.
Well, we hope you found this helpful. So, any other questions on anything we can address? Otherwise, we'll send it back to you, Tim. I'll just close by saying, on behalf of all of us at Empower, thank you for the opportunity to serve you and your participants. We really appreciate your time and attention. And welcome to all you new board members. And we look forward to continuing our partnership going forward. So be well, and you know how to get a hold of us. Have a wonderful, wonderful rest of your week. And Tim, back to you, sir.
I'll hand it back to Morgan.
All right.
Thanks, Gabe. Thanks, Joe.
Thank you.
Gabe and Joe, as always. And I think we're going to do cover the modeling scenarios next, Tim.
Okay.
That's right.
So I guess Joe and I can drop off. Be well, everybody.
Yeah.
Have a wonderful week.
Right.
Take good care.
Thank
Bye.
you.
Thank you.
Bye now.
Great. So a few months ago, we talked about our desire to do a risk assessment for our systems. By way of background, particularly for our newer members, we did a risk assessment in 2019. These are exercises where we look at not just what our assumptions would lead us to expect for our liabilities and our assets. We look at what happens if we vary from our assumptions in certain ways. And that can happen both on the financial side and on the demographic side. And so this risk assessment is really to give everybody an opportunity to see those potential range of outcomes and how they might impact the system. Now, one of the important concepts here is that, if we put in a scenario where we say, okay, imagine everything's bad. Well, the likely outcome is everything's going to be bad. So what we try and do is have a symmetrical view of let's look at things that are, potentially could occur on the upside and on the downside, and then see what that does to our system. So, and I should have stepped back. This is with the deterministic scenarios we run. Before that, Siegel is running a whole Monte Carlo simulation that looks at 10,000 different scenarios and says, okay, what are we expecting, the 50% outcome to be, 75 to 25% outcome. So that piece of work is already underway. What I wanted to make sure with the boards before we move forward with the deterministic scenarios, because they're the ones where we're telling Siegel, okay, run it like this so we can see what happens. I just wanted to make sure everybody was on board with the deterministic scenarios that we're going to run. So we've already presented it to the other two boards and wanted to make sure we run it by you. So what we decided to do is really focus on a couple scenarios on the financial side and a couple scenarios on the demographic side. On the financial side, we wanted to say, okay, what happens if we're expecting 7% returns over the long haul? What happens if they're 6 and what happens if they're 8? Because that would give us a reasonable measure of sustained underperformance or sustained overperformance and how that ends up impacting our funded ratio. So that would be one of the scenarios. Another is what happens with a shock, where we dramatically earn less than we expect or dramatically earn more than we expect. How would that impact the system? So that's the second deterministic scenario we're recommending. And then the next two have to do with demographics. This is actually not out of the realm of possibility when you look at current conversations in the education space and consider that in VMERS, a substantial number of our participants are in the education space, and there could be, real realignment of how we deliver education in this state. So what happens if headcount goes down or up? That's the third scenario. And then the fourth is out of anyone's control. Just what about life expectancy? What if, medical breakthroughs kind of advance the average life expectancy, or what if we have another pandemic or something that brings it down? So when I was talking to Matt and team, they really focused on this package of scenarios as around the most consistent that boards would like to see. These are the typical things that they would run, and so it's what they're recommending. They actually it was a little different at first, but we worked with them to mold it into this package, and so we think this makes sense. We're not looking for any official action here, but I did, before moving forward, this was an opportunity to bring this to you folks and see if this feels right, if you have any concerns. I'm happy to talk about it.
Yeah, I don't have any concerns. A couple of clarifying questions, I guess. The first is that you brought this to the other two boards.
Yes.
Already, they're good with it?
Yes.
Okay. And then the work that Matt and crew are doing right now, those bajillion scenarios that they run, that's both return and demographic changes, correct?
It's going to be mostly return, as I understand it. Yet they're going to really be focused on the return piece and do any rate using different capital market assumptions, then just run variations from there.
Gotcha.
And Matt did talk about, he is looking at it. I haven't followed up with him yet, but I plan to soon. I think there was some conversation in another board. Well, what happens if you get some kind of bonkers scenario? Basically, I think would be the technical term in those 10,000. Do you do any exclusions? His commentary at the time was no, because that's the whole point of doing all these assumptions, is that you would expect that some of the scenarios would strain credulity out of the 10,000, and that gets kind of washed away as noise. What we're going to see in these is a lot of graphs that have like a range of the 50% midpoint, 25 to 75, and then 5 to 95% likelihood of occurring, just so we can see where the system will be placed, and then we can all bring our different judgment to bear about, whether or not that calls for any different action. I don't know if that's helpful.
Yeah, it does. Any other comments or questions from board members, concerns from board members? Okay, I think you're good, Tim.
Okay, great.
And then still you on miscellaneous items.
Yeah, and for these, again, these were all things that I don't think, happy to talk about any of them, but they mostly sort of speak for themselves. We did have changes to open meeting law. Part of that is reflected in how we're redoing the agenda, that we have Bill here in person at the treasurer's office as our dedicated in-person space. Feel free to read those, and if you have questions on them, you can reach out to us, and Justin will help us work through any of those. This time of year, we've started actually, I think last year, putting a board membership memo out there just so everyone can refresh on terms, correct anything that we have incorrect, and be ready for any upcoming elections or notifications we need to do, which we typically do in the spring. So this is our way of getting just level setting with the board on where all the terms are. If you see something that looks off, feel free to say something. But we think this accurately reflects all the terms, and happily, we don't have to do any elections this year for this system. It's a lot of mailing, so we're always happy when we don't have to do that. And then I just put together some initial thoughts on a May in-person meeting in response to requests for folks coming in. There'll always be a hybrid option. So, to the extent can't make it, I'm looking at you, John, it's a haul, understand it. But what we're trying to do here, and what the thought we had, is it would be a good opportunity to meet some of our key vendors in person. And so, in particular, I've already flagged for Empower and Siegel these dates, and asked them to hold them so that we could just have them come in for one overnight and not have to fly back and forth. It would require us to move our May in-person meeting to the 7th, 1 to 4. But I'd ask that you hold that time. I think it'll be a good opportunity for us to not only meet the vendors, but maybe chat a little bit more informally. I had initially talked about some fiduciary education, and while I still have that in mind, I also am cognizant that 3 hours can go quick. And so I know, we'd likely have Siegel present a risk assessment that could easily eat up an hour. And so I'm still trying to figure out the agenda, but as I'm doing so, I just wanted to give you folks an idea of what I'm thinking. This is ultimately important, to work for everybody here. So if you have any comments, thoughts, concerns, feel free to give me a shout about those. But this is generally the direction we're marching, unless we're moved.
Yeah.
I think I would only suggest that if we are set with our fiduciary advisor and we can prioritize the fiduciary education while we're in person, even if we needed to extend the meeting by an hour, I imagine that would be time well spent. Just a thought, or how we navigate the time for that agenda. I think these questions in the context of this environment that are definitely sort of those that we could be guided through with a fiduciary are pretty timely and important, and might generate more conversation than other times or other topics. Just a thought.
That makes sense. I do plan to have whoever we end up going with for a fiduciary advisor there, provided we can do it. I would think that those questions would focus a little bit more on the DC plan as opposed to the DB, because we have our legal counsel who we've been using for fiduciary education on the DB side. What I haven't thought through yet, not having that entity on, and why I'm still kind of thinking through this, Kim, is I wasn't sure if it would make sense to do more of an investment review with them, or a more general fiduciary education. So I fully expect to have that group in here in some form or another, but I kind of wanted to get them on board and then talk to them about, what might be the most useful type of presentation, recognizing that we're going to have Empower come back for this one as well. So very much
That makes
thinking
sense,
through
and I
that.
definitely,
Yeah.
yeah, great. I might put a plug for just in VPIC, we do have fiduciary education that happens at our in-person, and that often allows to have set the table and the framing around our roles and responsibilities in the work that
Yeah.
would then follow with the conversations regarding any decisions and policy setting on the investment side, particularly for the DC plan. I think on the DB plan, VPIC is, hyper focused on the investment pieces of that. But I'm thinking about our roles and responsibilities, having real clarity on that as we're embarking on decisions regarding policy for the DC plan. Just my plug.
Yeah, no, so that's a really good point, and maybe the way I'll think about this is from a decision. Are there decisions that we think might be useful to make in that sort of near term, either at the May meeting or at a subsequent meeting? How do we utilize the advisor to inform and guide those? I think that's a good framing, and I'll think about that as we try and firm this up. Thank you for that.
Anything else from you, Tim?
That's it for me. Thank you.
Any other business from board members? Seeing none, I will entertain a motion to adjourn. See Kim and John. All those in favor of adjourning, please say aye.
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 And we are adjourned. We'll see you all in March.
Take care, everybody.
Thanks, folks.
Thanks,
folks.
Morgan.
Stay
Thanks,
warm.
Jim.
Bye.
Good. See you.